We're now going to have a commodity-focused session looking at nickel. Nickel demand from new markets and supply-side risks, creating opportunities. And we're delighted to welcome two experts on this subject. Clive Whittington, who's the Managing Director of CM Whittington and Associates, which is a company involved in the trading of nickel, and also works in original R&D, looking at applications for nickel. Wide-ranging expertise on the subject. And also Stefan White, who's portfolio manager with Lim Advisors, a hedge fund based here in Hong Kong. So, gentlemen, if you'd like to take the stage.
How do I? Okay. Thanks very much for coming to listen to us today. So my name is Stefan, and this is Clive. We're going to give you a brief overview on the nickel market, where we think nickel prices could be heading, and Clive is going to speak a little bit more specifically on some applications. And hedging for the nickel market. In conclusion, we basically believe that supply can meet demand, but there is going to be pressure on prices to the upside for nickel price. We think that technology and innovation will basically help meet some of the pressure for Class 1 product going towards the EV and battery space. So we're not expecting a real hyperbolic rise in the nickel price as you've seen in some other commodities around the EV space. But we do think that there is some pressure and the prices could increase somewhat from where they are today. The following table is going to show you the last 5 years of nickel prices, and you'll see that nickel prices are above their lows seen in 2016, but also above some of the peaks we've seen. You can see this table here just shows you the last 5 years. And if we were to go back 10 years, you'd also see that the price had spiked substantially higher from where it is today. And today we're slightly higher than that point there, although the nickel price did drop a bit yesterday. The market still remains fairly well supplied at the moment, with about 13 weeks of stock, and we don't see the market becoming particularly tight in the near term. We think that one thing that it is important to be mindful of is that the quality of data for nickel has deteriorated significantly over the last 10 years, as it has for many other commodities. So to understand what's happening in the nickel price, you need to be looking at a few different data feeds. So there's obviously LME, the Shanghai Futures Exchange, and also inventory kept in Singapore and Malaysia. And the following table is basically going to show you those three different data points that we think are important to look at. So the red being LME, green being Shanghai Futures Exchange, and the blue being stocks in Singapore and Malaysia. And these show some tightening of stocks, but at 13 weeks, the market still remains pretty well supplied. In terms of consumption of nickel, there's a number of different end uses, but there's really three end uses that we believe are principally going to be driving demand. And the largest end use is still stainless steel, and that'll be driven principally by demand in emerging markets, such as China and India. Then will be the non-ferrous space, which is specialty materials, for example, in aerospace. And then obviously the strongest driver, but coming from a fairly small base, is nickel used for batteries. And currently about 3% of nickel is going towards the battery space. And there's speculation that by the mid-2020s this could be over 10%. So that's a very material increment, as the following table will show. So you can see batteries are about 3% today, and by the mid-2020s that could have tripled or quadrupled, which is quite material. If you look over the last 10 to 15 years, the world nickel supply has increased significantly, but it is important to identify where this increment in nickel supply has come from. And virtually all of this supply has actually come from laterite mines and specifically nickel, producing nickel pig iron. In terms And it's important to note that obviously this class of nickel cannot be used for the battery space. And so the following table is basically going to show you this increase in nickel supply and how much of it has come from NPI, nickel pig iron. And what the following table is not going to show you is the split between sulfides and laterites. And I can talk about that as we view the slide. So the orange is the increased nickel supply coming from nickel pig iron. And the blue comprises both laterite and sulfide production. But if you were to split out the sulfides, you'd actually see a gradually declining line, going from the left to the right. So this decline in sulfide production is what's given many people in the market a concern or a view or a belief that there's an opportunity to basically really go long nickel because of a belief that the need for class 1 nickels for the battery space is going to result in a huge spike in prices. The following table is basically going to show you a breakdown between sulfides and laterites, and you'll see that in the laterite space, it's only the high pressure acid leach mines that are able to produce the class 1 material that's used in the battery space. And the cost of bringing these new high pressure acid leach process plants to production is huge, and so there has been some concern in the market that there could be dwindling supply for battery grade material, as you can see from this table here. So you'll see that today, that first line shows you about 34% of nickel comes from sulfides, and that's actually declining at a pretty steady clip. And then the second line shows you material coming out of high pressure acid leach processes, which also produces battery grade material. And there's only a finite amount of supply there. And the rest of the material at the moment doesn't provide you with battery grade material, and it's pretty unlikely that there would be an economic way to provide that. So just as they say that oils ain't oils, you can say the same about nickel. Nickel ain't nickel. There's a lot of different types of nickel. So this has given some people, at the moment, there's a mentality that we may be reaching, let's call it a sort of a peak nickel situation. But just as in the oil markets, how the peak oil narrative has now, I think, largely been discredited, we believe that the narrative of potential peak nickel is also quite unlikely. There is there's mines that have been closed that could come back, be reopened. There's potential expansion of existing mines. And then lastly, there actually are quite a number of potential greenfield mine sites in Indonesia, in Philippines, and in Papua New Guinea that we believe could potentially be reopened and be able to supply class 1 material. And the following table basically outlines some of the mines that we've identified that could potentially reopen or expand, or that could be greenfield. Now, the sum of these, in terms of thousands of tons per annum, for people that are very, very bullish on how quickly battery demand may grow, in a very, very strong growth scenario, you will see pressure. You should see pressure on price, because adding around 200,000 tons per annum, in 10 years' time, could result in tightness to the market. And some of these these mines could take quite a bit of time to sort of ramp up, especially if it's a new greenfield. To talk a little bit more about nickel sulfate, I'll hand over now to Clive.
Thank you, Stefan. So just to take it further and address more closely the opportunity for nickel in electric vehicles, I'll begin by talking about nickel sulfate, and this is a favourite subject of mine. I think I have it under my fingernails because nickel sulfate has been used for ever and a day as the basic material for the electrolyte in plating. And here in this part of the world, decorative nickel plating, 75% of it takes place between Japan and India. And that is growing. It's consumer products. So nickel sulfate is well known to us all in terms of both quality, volume, and the sources. So the reason that it's used in batteries is that nickel sulfate, 6H2O, is ideal for all electrochemical applications, and batteries and plating are simply the reverse of one another. So for the plating electrolyte and for precursors used in lithium-ion batteries. And as Stefan has said, the feedstock can be and is today either from sulfide or increasingly from lateritic ores. And we believe that new and innovative process technology will take the raw material feedstock from those mining operations, take the intermediates and readily convert them to nickel sulfate. But of course, there's greater emphasis nowadays on the cobalt credits, and so technology that will provide both nickel sulfate and cobalt sulfate is essential to extract the maximum value from the mine and intermediate production. I would just mention that since my business with my partners, we have the largest distribution footprint for the plating market in this part of the world. And the attraction of nickel sulfate to producers, not only for plating, which exists here and now and is growing fast as consumer products and automotive production increases, but the premium you get on a ton of nickel, if converted and sold as nickel sulfate into this market, is between $2,500 and $4,000 a ton CIF main port Asia, and that is rising as demand from the battery industry increases. And I'm speaking of pure, not just second grade product. And that's the sort of returns you get if you're selling into the battery industry. So the line to production of nickel sulfate and cobalt sulfate as byproducts is very attractive indeed. So if we have a look at some of the sources that prevail today, recycling, not so much as we said yesterday in our panel for the cobalt and lithium, because they haven't been in the market very long. But nickel for batteries has been around a very long time, and that's the well-known nickel cads and nickel metal hydrides. And so already there is feedstock coming back into the recycling system, which we estimate to be around about 20% of supply. But of course, that will take a while before the lithium ions come back into the system, perhaps 10 years and more. So the existing methods from MAT, such as with nickel at Norilsk Nickel at Harjavalta in Finland, crude nickel sulfate comes from the copper refineries and the platinum mines in South Africa. Nickel hydroxide is the new and exciting one. It's an ideal product to make, from which to make a nickel sulfate. dissolves easily. It's purchased at LME minus maybe 25%. And mixed sulfides, this is largely Sumitomo in the Philippines, at Taganato and Coral Bay. There's an in-house operation, but more recently there's a heap leaching operation of Terrafame. Has been revised in Finland. How it will go second time around, I'm not sure, but they have great ambitions. These are taking a long time to build up. So the gap here is the dissolution of pure nickel powder or hydrometallurgical briquettes, such as BHP offer, Ambitovi, Glencore out of Murrin Murrin. But BHP is going big in that area, and they're going to produce they're planning a plant to start next year, 100,000 tonnes nickel sulfate. That's a lot, isn't it? But that can take up very quickly the gap that needs to be filled to provide the production pool. Carbonyl nickel powder, which is Vale and Clydach in Wales, and in Coppercliff, Canada, is a very expensive but a very fine feedstock. And finally, would you believe in India, people will cut up electrolytic cathodes and dissolve them and make nickel sulfate. So, taking the mixed hydroxide precipitate, which is an ideal feed, and we heard from Craig Lennon earlier this morning from Highland Pacific about the Ramu project, and that is an ideal feedstock. For chemical companies who purchase that, they're buying about 33% nickel and about 3% of cobalt, from which they can extract both. And as Craig showed us this morning, that's fully operational, 34,000 tonnes nickel content per annum, and about 3,300 tonnes per annum of cobalt as a mixed hydroxide precipitate. Ideal, you can ship it in bags and then dissolve it and make nickel sulfate with a purification process. So then just to talk about the step necessary to take feedstock of any sort, we talked about crude nickel sulfate, this one, which is an ideal product, mixed hydroxide, taking powder or briquettes such as BHP will do at Kwinana and are building now, and other sources. The key is if one is going into as a chemical company, processing company, going into the production of nickel sulfate and wishing to extract the maximum cobalt out of it, which is worth a lot, then the technology to do that is the key to it all. And there are a number of examples, and we've heard some of those today, and others I'm familiar with, but just for the point of illustration, a company called Alpha Fine Chemicals in Perth is about to build in Kwinana, which is a very fine industrial area where both Alcoa and BHP are located, and ready availability of sulfuric acid from the fertiliser works. And the technology being used there will take a variety of feedstocks. So on the left, we've got the mixed hydroxide product, which is very, very attractive because it carries the cobalt with it. And the process can extract both the nickel sulfate as well as cobalt salts. Ideally, take it to cobalt sulfate, and you have the two products for the batteries. And other sources, such as mixed sulfides, nickel matte, the traditional one that's used, nickel oxides, which will possibly come to the fore, could be Goro, Vale, and of course nickel powder or briquettes, which is a very simply dissolve in acid and stand back as it generates clouds of hydrogen, which makes it rather exciting. So for the supply chain, perhaps the greatest risks, other than that of technology, not as Stefan has said, we don't think there's a supply risk, but the biggest risk facing anyone in the supply chain is the extreme volatility of prices. And we saw only last week nickel price shoot up by $1,000, only go up like a rocket and down like sticks, so down 600 last night. So if you're caught in this cycle, it can really have a huge impact on one's bottom line. But there is an answer to that. In my own case, for nickel, nickel sulfate, and nickel chloride and nickel sulfamate, which we sell to the plating industry from southern China to Invercargill in New Zealand, with our distribution footprint. Were we to step out of line by $1 or $2, we would not survive. So as I speak to you now, my staff in Seung-Wan are hedging, unwinding the hedge, and as we buy from the principals in as far away as Finland and Norway, France, Japan, our customers are buying it, or our distributors are buying, and we unwind the hedge. Now, that we do also for our customers down the line, as Panasonic making an iron, Toyota who make a car. They want the nickel price locked in. They want to know what it's going to be for the next 12 months. And we can do that. We buy forward up to 2 years. And that means that when you make a motor car, every item in that is hedged, and very much so the aluminium, which is vast in the casting business. So what I would advocate is for those going into the EV chain, from the mine to the intermediate, to the chemical processing, to the precursor, to the battery cell, to the battery pack, to the end user, be it EV or be it storage. It is possible to protect yourself from risk at every one of those stages. Every time the title changes, you can cover your risk. So the three key elements for the EV business are nickel, cobalt, and lithium. So how to manage it then? The London Metal Exchange has contracts for nickel metal, and one can hedge the nickel content of the nickel salts, nickel sulfate, nickel chloride in my case. There's also a cobalt contract, but it's not a very liquid contract. But you don't hedge the chemical, you hedge the metal content thereof. In nickel sulfate, that's 22.3, cobalt sulfate, 20.5. That leaves you then with one, a not very liquid cobalt contract, and lithium. So what do we do about lithium? Well, the LME has allows us to tell you that in about the middle of next year, there will be a contract for lithium carbonate. So wherever title changes in the supply chain, from the mine to the intermediate to the chemical, to the precursor, to the battery cell itself, to the battery pack, and to the final end product, the EV or electric or power storage systems. And the lithium carbonate contract will not be the metal, it'll be the lithium carbonate equivalent. The cobalt contract, which is not very liquid, will be changed at the beginning of next year, so it'll be a liquid contract that can be very readily cash settled. So finally, stainless steel, as we saw, is 73% of nickel consumed today. And the question is whether any of that nickel can be converted into the route that will take you into the production of nickel sulfate and extract the cobalt, which is not coming out in the stainless steel feedstock, class 2 feedstock. So we say yes, it is possible to take some of that nickel, which is going into stainless steel, and is either as a metal, it can be briquettes, or it could be electro, or it could be a nickel oxide, such as Vale produce. And all of that can potentially be fed into the stream that will be an intermediate from which to make nickel sulfate, but above all, to extract the cobalt, which is not presently extracted. Yes, there are two areas where it's not possible to feed into the nickel sulfate stream, and one is ferronickel, which is a very fine product for melting, and nickel pig iron ditto. So, as Stefan said before, we think there is enough nickel around to meet demand. It's simply a case of converting it into the form that is required. And just as an aside, my view is that 10 years out, whilst nickel into stainless steel is now 73%, that percentage will drop. I'm not saying this, the consumption will drop, but the percentage as the nickel market as a whole will drop to 60%, and batteries will take over that space. There is a huge upside, and the beauty of it for anyone going into this business is the premium that you get on the metal contained in that chemical. Not just selling metal at, as a briquette would be sold at the premium of $350, selling it today at $2,500 up to $4,000 and rising. In the case of the cobalt, the metal content is today priced at $91,000. But when you put it into cobalt sulfate, you get a premium of $3,000. So it's very attractive business going into this EV stream, and the demand is there. So we say it's a good business to be in, and anybody interested in participating, and we've heard from a number of new projects, all of which I believe are very well worth looking at, providing the nickel content's not too low and the cobalt content's not too low. I think there is a huge opportunity ahead of us. So in Stefan's and my view, the wheels are turning. And if you're wondering what on earth that is, it's an aluminium wheel, beautifully plated with nickel and chromium, and that will resist corrosion when salt is put on the road, makes it easy to clean. And when that car goes to the wrecker, that wheel with nickel as the basis for protecting from corrosion and the chromium to stop tarnishing will be as good as the day it came out of the showroom. Thank you very much.
Clive, I'd better address this to you. In my past life, I used to get involved with hedging commodity derivatives. And there was a time when that was a very active market. And there seems to be a lot of emerging needs here. And some of them are popping up ahead of the ability of the futures market to serve those needs. Are you seeing any development of commodity derivatives, over-the-counter commodity derivatives to hedge the pricing needs?
No. No, I'm sorry, I'm not. I'm a very simple soul, I'm afraid. We simply purchase nickel from the nickel sulfate from the producer, and we lock that price away. And when we sell it, we simply unwind it. So we're not very sophisticated. But that is all that you need to do in the battery supply chain.
So let me ask the question a different way. There's one new futures contract coming for lithium carbide.
Yeah, yes. So the LME...
Do you see a need for the others?
Oh, for any others?
Yes.
No, I don't. No. So I work quite closely with the LME, and there was the thought that it should be a contract for nickel sulfate and for cobalt sulfate. But I use the illustration, and nothing new under the sun. You take the metal content of the product, and that's good enough. But lithium is not a lithium metal contract. It'll be a lithium carbonate equivalent contract. And that one, there won't be a physical because it's no intention of putting it into a warehouse. But it will be a paper transaction. And so it'll be a cash settled transaction as opposed to a physical.
You see that as a new trend on the LME, more cash settled?
Yeah, I think quite frankly, but here we are in Hong Kong, and it's owned by Hong Kong Exchange, as we know. And I think there's a lot of pressure. The Shanghai Futures Exchange, in the area of cobalt, there are price points which are well recognized, Metal Bulletin, Bloomberg, and so on. So the LME's got to be very careful that they don't slip here. And there's a lot of change taking place. Even there's a challenge to the ring. A number of the traders with whom we deal saying, what do we need a ring for? It's the last open outcry exchange in the world. I like the ring. It's great because for the first 100 years, the LME was based in Whittington House, which happens to be my surname, in Whittington Street. And not related to Lord Mayor. But they are under a lot of pressure to keep on the front foot. As you know, the trades have been dropping off pretty much since Hong Kong X took over. So it's pretty serious stuff. And so they're trying to be innovative. But you've got a pretty good grasp of it. Thank you.
Well, thank you very much for the question. Unfortunately, we've run out of time there, but thank you very much for a very insightful presentation on the nickel market. And have a round of applause for Clive and Stefan.